What's going on, guys? In this video, we're going to be talking about the benefits of investing in low-cost index funds, specifically ones that are tracking the S&P 500 index. So the S&P 500 is the top 500 companies in America by market cap, all in one big, beautiful index. And even though you can't invest in this directly, you can invest in an ETF or an index fund that tracks this benchmark. A very popular one that we have probably all heard of, the most popular one, is the SPY. This is tracking all 500 companies, and this is a great investment, but it's not the best one if you are looking at the long term. So you may be thinking, what do I mean by that? What's going to be a better S&P 500 ETF than the actual SPY? And that's a good question. The answer is the VOO. Virtually the same. It's going to be tracking the same 500 companies by market cap, but there is one subtle difference. The SPY has an expense ratio of 0.09%. So an expense ratio is pretty much the fees that you are paying to the ETF to be maintained. And it's a very small fraction, but over time that eventually adds up. So that's the SPY, 0.09%. Now we're on the VOO, is 0.03%. So it's actually 3 times cheaper than the SPY. Now, even though it's 3 times cheaper, it's still, we're talking about a little tiny fraction of a percent. So in the short term, it may not make much of a difference. But if we start to look long term, so this is the VOO, let's go out 10 years, we could see the performance. It has gone up 188.79%, which is actually beating the benchmark by a hair. The benchmark S&P 500 is at 188.53%. But again, let's focus on 188.79. And then if we look at the SPY over 10 years, it's only 187.57. So the SPY is actually performing worse by 1%, by a little over 1% worse than the VOO. Now that may not be a lot of money, or that may not seem like a lot, but this is 10 years. So you start to go 20 years, 30 years, or even 40 years out. Now you're starting to look at 4, 5, or maybe even 6%. And 5 or 6% can mean tens of thousands of dollars depending on how much you have invested and how early you start investing. So now that I may have convinced you that the VOO is a better option than the SPY, especially for you long-term investors, you may be thinking, should I actually invest in an index or should I stick with good old stocks? Here's an article from Bankrate that does a good job breaking down the difference between stocks and ETFs. We should all know a stock is ownership of an individual company. ETF is ownership of a basket of stocks. But now you may be thinking, okay, well, which one performs better? ETFs go up on average, tracking the S&P 500, an ETF may go up on average 10% over the past 100 years, but you can invest in, say, a stock like NVIDIA, and that could go up 100% in 1 year. So you may be thinking, which one should I choose? But remember, you got to look at the long term. So long term, people who invest in well-diversified ETFs, such as ones based on the S&P 500, so that's the VOO and the SPY, beat most investors over time. And you may be thinking, wait, they're beating the most investors by how much? You could see right here, this paragraph right here, a 2022 report. So this is a very recent report from the S&P Dow Jones indices shows that more than 85% of fund managers investing in large companies underperformed their benchmark in the prior 12 months. And then over a long time, it's 83% are unable to beat the market. That's over 10 years. So sure, you could be that lucky rare 15 to 17%, but chances are you're not. Statistically speaking, you're going to be on the other end of it and you're not going to be able to beat the benchmark. So you're better off putting it into an ETF than trying to handpick stocks yourself. Now, the great part about that is it is the lazy way to invest. There's really no thought to it. All you have to do is just go on to whatever your brokerage account is. So here's TD Ameritrade. You type in VOO, you smash that buy button, type in the quantity you want, say you want 10, hit review order, place order, and then you're done. And you just rinse and repeat over and over again until you're ready to retire. But now for those of you who are a little bit more technical and you want to know exactly what you're getting your hands into, what are you starting to invest in if you were to buy the VOO, here's just a simple breakdown. You can see here's its breakdown by sector. So you can see the majority right now is in technology by 24%. Got healthcare, financials, consumer, cyclical, communications, industrials, consumer defensive, energy, utilities, real estate, and basic minerals. And here's a nice little pie chart showing that breakdown. And then if you scroll down, you could also see the top 10 holdings. So Apple, Microsoft, Amazon, this is Google, Alphabet's Google, Tesla, Berkshire Hathaway, that's Warren Buffett's company, United Healthcare Group, Johnson & Johnson, and NVIDIA. We all know these companies. These are all the companies that are skyrocketing and going to the moon over the past 10 years. You already have a piece of that company. You are part owner. Here's the actual breakdown. So these top 10 companies make up a little over 26% of the actual ETF. But the beautiful part is what happens when Apple's day has come and it starts declining, like IBM or Microsoft, or what if NVIDIA is no longer going to go up 80% in a year? Maybe it's going to have a rough couple of years. You have 490 other stocks within this ETF that could start to blossom or moon, call it whatever you want, make some serious gains, and you're going to be enjoying those gains because you hold the VOO. And this is why most index or ETF investors will beat out the active traders, people trying to actively trade stocks. And another benefit people really don't realize, but because you are owner of 500 different companies with this ETF, you also get dividend payments, quarterly dividend payments. If you own one share of the VOO, you're going to be paid out roughly $1.30. You could see over the past 4 quarters, we got $1.31, $1.53, $1.37, and $1.43. So every quarter, you're getting paid that dollar per share that you have. You turn on drip, you could have that starting to buy more shares for you. And you are completely passive. You're completely on autopilot, beating 85% of your peers. So end result, I am a huge advocate for you buying up individual stocks. I love doing that. It's fun and exciting. But if you're someone that wants to take the easy, laid back approach, or even just to have that maybe in an IRA, you have a brokerage account that has your individual stocks, but then you have an IRA or a retirement account that you don't want to be too aggressive with. Yeah, I'd say the VOO is a great place to park your money. Not financial advice, but there's plenty of professionals out there that would say that this is financial advice. So leave it to them calling it financial advice. I'm just calling it an opinion. But guys, if you like this video, make sure to smash that like button. And as always, I will see you in the next one.